Well, hi everyone. Thanks for joining us today. Can everybody hear me okay? I can hear a little bit of echo. That's good. My name is Justin Biebel.
I'm Blake Ichabone.
And we are from Think Liquidity. Think Liquidity is a Grand Rapids, Michigan-based risk management services and technology services company.
Yeah, so today we're going to talk a little bit about this idea of crowdsourced risk management, and in particular how you can use it to optimize profits on your A and B book allocation strategy.
So I'm the head of options and risk strategy at Think Liquidity, and I work with our clients to incorporate options as a risk management tool and also use options as a commercial product. I've had the opportunity to work with Blake on a very exciting project over the past few months. It's kind of folded into our presentation a little bit today. And prior to Think Liquidity, I spent time as a market maker on the floor of the options exchange in Chicago, and I managed the options desk at GFT and Gain Capital.
I'm the head of the quantitative analytics department at Think Liquidity. I was previously a lecturer at Michigan State University, where I was working on a PhD in applied topology. So I've been able to bring some of those techniques into the Forex world. Namely, we've been applying some modern mathematical techniques to FX flow, and we've developed a few new metrics for risk analysis. All right, so here's just a little quick slide that discusses the big picture topic of today's presentation. We're going to be talking about sort of crowd intelligence and a methodology to harness sort of an organic form of artificial intelligence. You've probably often heard of people talking about, the collective consciousness and how you can get information out of swarms and large groups of individuals. So, what we have been able to do is source information from a crowd by using big data techniques and then filter that content. The tricky part there is determining which attributes can be meaningfully used to filter the data set. So we've done that in a few different ways that have been extremely correlated to P&L. And finally, once you're able to do this, you have to be able to apply that content to manage A and B book allocation and maybe get some market signaling out of it. So let's talk about that. Well, what we're going to dive into right now are just a few examples just to sort of get our feet wet and get going with the conversation. So Google, everybody uses, I'm sure, probably is the biggest provider of crowdsourced information. The PageRank algorithm uses machine learning techniques that basically use a probability matrix and some eigenvectors so it's actually the Perron-Frobenius theorem that's behind this technique, and it's a big data algorithm. Essentially, because they have so many people clicking on pages, they're able to give a prediction of what you will look at based on your previous web browsing activity that is extremely pinpointed. So that's an obvious one. So here's maybe a little bit more of a fun example. I don't know if anybody in the room is a gambler, but if you're familiar with the betting lines in Vegas, the odds are, notoriously very hard to beat. And the reason that they are is because they are sort of tapping into an organic form of artificial intelligence. When the initial line is set, you have action being placed on either side, and then just simple market-making strategies move that line towards a sort of optimum value. And just in making a market, you're able to get something that even one or a team of sports betting professionals are unable to produce. So I mean, it's not like you have some quants that are producing these lines. It's actually the swarm of gamblers who are able to set those lines. And just in making that market, you get something great. So that's crowdsourcing.
Kind of a third example, and it's slightly different application of crowdsourced content, is Airbnb. And that is a business model that is completely reliant on crowdsourced content. If they didn't have any cool properties or any competent hosts, they wouldn't even have a business. So they've managed to tap into the lodging industry from a technology perspective and completely disrupted, a brick and mortar based industry. So it's a platform that's completely relying on crowdsourced content. And one interesting note with Airbnb, in fact, they took crowdsourcing to a whole nother level. They wanted some video content on some of the properties, but there was really no practical way to go around the world and film all these beautiful properties. So they went back to their business model, and they were already using their crowd to supply all the hosting and lodging, and they thought, why not let them also source the marketing content as well? So after all, like who knows more about your house than you? So what they did is they asked for entries to submit a 60-second clip, and the winner shared about 20,000 euros. And the millions that they saved in production costs was tremendous, and they also got just thousands of hours of quality content. So transitioning now a little bit, here's kind of a famous classic toy example of crowdsourced intelligence. In 1906, British scientist Francis Galton went to the annual West of England Fat Stock and Poultry Exhibition. He came across a weight judging competition there, and there were a lot of non-experts mixed in with some experts, butchers and farmers and clerks and your typical punter. He was interested in finding out what the average voter was all about. So with the 800 entrants, he took the full sample from high to low, plotted them all out, and he figured the average guess would be way off the mark given the mix of entrants. Saw the low quality input going into this, and there was no way that they could come up with an accurate estimate. So just taking a quick poll around here, we're talking about a fully butchered and dressed ox. Anybody have a guess on what the butchered weight would be on this ox? 700 kilograms. Can you convert that to pounds for me? Yeah? Anybody else? 800 pounds, okay. 1,000 kilos. Okay. Well, it turned out the average guess was 1,197 pounds. Okay. The actual 1,198 for a difference of just 1 pound.
So, I mean, admittedly, this is a toy example, right? Maybe you're thinking like, okay, you've done a poll, you've taken an average, and of course there was error cancellation on either side, so you've arrived at a better result. But what's not like really being talked about in this toy example is what's going on behind the scenes. You have human brains, not machines, not computers. You have human brains making estimates, and so we're taking an average of something that came from an organic form of intelligence. So, I mean, maybe you do have examples where the crowd is maybe wrong, maybe not so smart, and I guess we'll get into that in a little bit and talk about how we partition that data to get really fine results. So here's a quote. Yeah, I really like this. It kind of highlights everything that we've been talking about so far. Google wouldn't be able to deliver the search results without tapping a crowd, and NFL betting lines wouldn't be as precise as they were if it weren't human beings making these decisions. And Airbnb wouldn't be a highly successful company if it didn't have like individuals going on and producing high quality content that Airbnb is able to tap into. So this quote, under the right circumstances, groups are remarkably intelligent and often smarter than the smartest people in them.
Yeah, so these platforms have all demonstrated an ability to tap into the intelligence of their respective crowds. And by doing that, they've delivered products that are just better than what else is out there. And they're better than what any single team or single individual can really come together. So we've gone through a few examples where it looks like the crowdsourcing method works really well. And now let's tie it into FX a little bit. I'm sure we can all think of a few examples where maybe the crowd was, not just wrong, but wildly wrong. We have an example here with Brexit, where maybe the crowd really wasn't that smart. June 22nd was the day before, and the general consensus from Bloomberg, and not just Bloomberg, but many other sources, was that leaving was just not going to happen. So, just a 19.6% chance of leaving. Even as the polls were closing, it tightened up even more to just a 10% chance of leaving. So,
How did that work?
yeah, so in the days leading up to the vote, we had a steady climb in sterling. Vote comes out, pound crashes, crowd was wildly wrong. So the option markets and the bookies, saw a 20-25% chance of this happening, and even as the polls closed, we saw that narrow down even further. So while the crowd as a whole was massively wrong, there were actually quite a few people who got it right and were positioned correctly for it. So they may not have predicted necessarily the outcome of the vote, but they were positioned right to profit from it. So the interesting question becomes, is there a way to partition this crowd into the winners and losers before the event actually happens, right? And even better, can we partition the crowd into groups where we can actually describe the extent to which they're right or they're wrong? So it's a similar content issue that Airbnb had to deal with when they were getting thousands of hours of video content. How do you separate the good content from the bad? And how do we separate the really good from the really bad? And
Yeah, so how was the crowd for Brexit? I guess overall, they were wildly wrong. And similar, if you followed the US election at all, pollsters were wildly wrong there. So maybe there is this trend that the crowd as a whole is not always right, but it's our belief at Think Liquidity that there's a lot of very good information there if you know how to partition the crowd into subcrowds.
Thank you, Mr. President, for your insight.
So for us, FX Flow is crowdsourced content. The content is trade data, and the crowdsource is thousands of client accounts. It doesn't mean you have to identify only good traders, even if there aren't that many of them. It's kind of a well-known statistic that about fewer than 25% of retail FX traders actually are profitable after about 6 to 8 months. A lot of people lose money, and so maybe in this case you're looking at the crowd and you're saying, well, the crowd is typically wrong. A lot of people are, even these bad traders are maybe good at something, like maybe they're good at losing money and providing contrary indicators. So again, there is a lot of very good content in this crowd as long as you know how to partition it up and how to use it.
Yeah, so being able to use this order flow content to generate signals is it's a database problem, it's a software problem, and it's a latency problem, especially in our industry.
So, I guess this presentation wouldn't be complete if we didn't do a little marketing plug here. So I guess now is the time for us to talk about sort of our proprietary trading system, trade scoring system. So we've developed a few scores that use some modern mathematical techniques. It's patent pending. There's really nothing quite like it available today. And so what we've done is we've taken multiple sources of pricing information, we've aggregated them into a base feed that has a lot of ticks, probably more ticks than most pricing sources because we aggregate like this. And then we examine each trade. For each trade, we examine every tick and sort of give a weighted metric that measures somewhat very roughly percent mass upward and a percent mass downward. And then we also, but of course, it's not quite so simple. And then we also do similar metrics for the entrance and the exit of a trade. So we have these three scores. One of them is like an overall metric that measures the amount of risk that is incurred by a trader throughout the body of a trade. And then another score that measures how optimal the timing on the open position, the open timing on a trade was, and similarly how optimal a trader gets out of a trade. So they're all good for different things, and they measure very different things. Like, for example, this exit score that I'm talking about can give you an indication of whether or not a trader is like very closely monitoring their positions, like watching the monitor all the time, or maybe if they're using an EA. An open scoring system is very good if you're trying to get market indicators for directionality. So QuantView kind of solves this database problem. We've solved the latency problem. We have a web portal. You go to a website, you log in, all of the trades are there. You can see account level information, you can see exposure information, you can see all of these metrics that I'm speaking of at each level. So there's beautiful graphics that show, heat maps of the exposure. There's sort of like, and I'll show you some of these graphics in a few slides, but you can see the size of the exposure, you can see the profitability, you can see metrics on the long and short positions to see if there's lopsidedness, and it's a sort of directionality indicator. The goal is for FX brokers to be able to manage their A and B book allocations in a very optimal and real-time fashion, and also for maybe if you're interested in prop trading, if you want to get market signaling, there's some very powerful information that comes out of that as well.
So let's talk a little bit more about the Brexit vote and how we used our scoring system for that particular event. So first what we did is we calculated the scores on each trade and assigned the overall score to the user. Keep in mind that this was all pre-Brexit data. We ran those scores through a probability density, and we developed that density generation in-house, and we used that to normalize all the scores. These normalized scores were then used to assign the users to buckets. And we created 10 different buckets. Actually, one of the buckets didn't have anybody in it, so we dropped it to 9 for this example. But finally, we measured the profitability of the traders in each bucket during and immediately after the event. So let's take a look at the results here.
So yeah, I guess you'll see in this graphic that the majority of the positions were unprofitable, and that's kind of to be expected. Like I said, at least in the demo, the people who have agreed to be our beta testers for this scoring system, about 78% of them are unprofitable. And right here you're seeing that the bottom 6 buckets are unprofitable, which is sort of to be expected. And there's always noise when you're looking at market data, but like Justin said, all of these buckets were made with pre-Brexit data, and this is measuring the performance during Brexit of the positions that were taken and closed and opened during this 4-hour window where the movement, or the most of the movement was happening.
So what's interesting here is that there's almost a linear increase here. So what it's telling you is the traders with the worst scores lost the most money, and the traders with the best scores made the most money, and it followed the line.
There's these 2 dots that sort of don't look right, but if you look at the chart, there's thousands of positions, and those 2 dots count for 6 of them. So if you want to, if we look at buckets that have actually at least like 20 or so positions, it's if you look at these numbers, they're actually monotonically increasing. So that's pretty good. And like I said, like most people did lose money, which is what we expect. And then we have a few buckets of high-performing traders. And so being able to match these things up gives like quite a nice signal.
Yeah, so this particular broker is primarily a B-book broker. I think most B-book brokers had a wildly profitable day that day. But if they had gone into the event where they were covering buckets 7, 8, and 9 and B-booking everything else, we're looking at over a 30% increase on that day's profits alone.
So maybe you're wondering, like, what does this look like, not just for Brexit, but for all time? So here's a graphic very similar for all time. And of course, there's noise sort of towards the middle, but it's mostly linear. Yes. Okay, so maybe you've played this game before. You're supposed to find the man in the stripes, find Waldo. Yeah,
There he is.
there's Waldo. And what we kind of are talking about today, and what we want to be able to help you to do, is very rapidly find all of the Waldos. So, I guess we've talked a little bit about these scores, and I guess maybe we'll get into the weeds here a little bit and talk about some of the probability theory that's behind it. We have data on hundreds and thousands of traders, possibly thousands from a single broker. So we've looked at a book of 50,000 traders. About 30,000 of them have made trades within the past 3 or 4 months. We know from in-depth analysis that we performed that the average standard deviation of someone's trader score diminishes after about 25 trades. And what that means is that after I have 25 data points on an individual, I have a pretty good indicator of how they're going to perform on that 26th trade. And of course, all of these metrics are recomputed for the user after every trade. So about, so every time a trade is placed, you get a new score on a person. It's kind of like your GPA in school, right? Yeah. If we have an account that has about 20 or so trades, and you don't know if this account should be A or B booked, we can use this metric to be pretty confident in an early on indicator, which is sort of a nice thing to be able to do. And yeah, so we often get this question, like this person is up X dollars, I'm a small broker, should I cover him or not? If I do cover him and he has a big losing day, I'm going to lose out on a lot of profits. So what we've done is basically use probability theory to show that if you use this approach, you can be pretty confident in the results that would come from using trader score. And similarly, we have probability distributions on the entrance and exit score, and they look, like sort of approximately normally distributed with some skew and kurtosis. And so that's nice, quite nice to anybody who's familiar with statistics, because now you can hand this to someone who's taken a couple statistics classes and does risk management, and they can pull this data down through an API, and they can do quite a bit with it. Or if you don't want to do anything super fancy like that, you can just log into our user interface, and we'll regurgitate all of the information for you and kind of give you like a nice analysis there. So there's sort of 2 ways that this product is being offered.
Yeah. So this data is made up of, like said, about 50,000 accounts, and there have been over 30 million trades analyzed already. So it's definitely a big enough sample to, feel like there's some reliability here on how the distribution lays out.
Yeah. Oh. Yeah. So here's a picture of the account scorecard on the user interface. So there will be on the user interface this list of accounts. You click on one of those accounts and you get this scorecard. It has the 3 scores that we've been talking about and a win-loss ratio bar and maybe some classical metrics that most risk managers will be more familiar with. So we're looking at like all-time P&L, equity imbalance, trade count, volume, things like that. And then over here to the right, some things that I find particularly interesting, especially if you have a lot of accounts coming in through an IB. Maybe you want to know if an account is, an IB introduced account is churning you for rebates. Well, we have like a metric over there that's designed to measure that. And maybe you want to know if an account with a very short trade life is doing some sort of high frequency trading. So there's also a metric to flag for that, and that would be, of course, the trades per hour. And then P&L per hour, of course, ties in with both of those things. Like if you want to see if a high frequency account or an EA account is profitable or not, there's a metric for that. And those are all classical things. And keep in mind, like this is customizable upon request. So if there's something that's not on there that you'd like to see on there, it could be put on there very easily.
Yeah, so going back to our example where we get the question from the broker, this account has lost X amount of dollars, what should we do with it? And if this was that account scorecard, the way we could break this down is first by looking at the overall trade score at 55, above average, not great, not terrible. But he has an open score of 97 out of 100, which is, outstanding, right? That means 97% of the population is trading or opening a trade worse than he.
So yeah, like just to remind you, like as I mentioned, we normalize with some probability distributions, and so these open and close scores, you can think of them as being, they are percentile scores. So a 97 means that 97% of people perform worse than this account in terms of timing the open position of a trade, and that's all in terms of like, profitability of the life of the trade.
Yeah. So very quickly, finishing this up, we can see that with an open score of 97, he has nearly 400 trades executed, an all-time P&L of positive 37,000. We have enough data here, especially when we compare it to the win losses here. We have a guy that, despite taking more losers than winners, is still significantly profitable overall. And so this would be a good candidate for us to consider an A-book account.
And we can show you more visuals like this at our booth. We can show you it on any account, so just come see us. So here's a nice top-down perspective. This is a tree map. The size of the rectangles are absolute value of exposure, and the color coding is profitability. Any risk manager is going to love this because you don't have to sort through like some list of numerical data. Like I have a graphic right here. I can see what are the big exposures, am I losing or am I making money? It's color coded, it's very nice. That's pretty self-explanatory. And here's alongside that, right next to that, you would get this fast facts sheet for your exposure and the profitability, and of course the metrics that we've developed can be displayed right there as well. So
what's interesting about this one is that, while we are gathering all this data on individual traders, here's where it all comes together in an aggregated form. So we look at, let's say Euro-Yen has that warning sign next to it. So what it's telling us is that all the accounts that are making up that Euro-Yen exposure have an overall score of 24. But the pool of clients overall that are in that position have a better than average score at 53. So what that's telling you is that while this is sitting in the winner column for the broker right now, we could expect those scores to converge from the exposure score to the client score. And this might be an exposure you want to take a look into and maybe lock in some profit.
yeah, and the exposure scores you'll notice are lower than the client scores at this time, but they do bounce back and forth, and it's largely because that net P&L is negative at this time. So if you were seeing like a big winning day, you would expect them to be maybe a little bit bigger than the client score. So what Justin is like kind of pointing out right now is that so we know this score on the clients, on each client. We know the exposure, so I can do some sort of fancy weighted average of those client scores to get the client score on the exposure, and then I can just score those trades that are live to get the exposure score. So the exposure score is like short-term, very short-term live scoring. The client score is a track record of those people who make up. So you can see like some really nice signaling just on this broker dashboard. So what we've designed is a user interface that allows you to take our partitioning techniques and apply it to your book. Your crowd does give you an amazing amount of content, and we want to help you to be able to apply it and do something with it.
Yeah. Describing your traders as simply A book or simply B book may not be the best way. Being able to dynamically manage your books based on an intelligent crowdsourced content base will really help you harness the power of your content. So identifying the meaningful characteristics should be the goal. Once you've done this, you let big data do the heavy lifting.
So yeah, we're at a booth, booth 79 at the opposite end of this building. Come talk to us. We'll show you a demonstration that's live right now, and you can click through it and see what it feels like.
Pour yourself a cold all-day IPA from Founders Brewing in Grand Rapids, Michigan.
From our own Grand Rapids.
Yeah. All right, thank you, everyone. Are there any questions right now?
Is it cloud-based? Do you expect people to upload their trades to you?
Right. So there's an onboarding process where we do the integration. We get basically a dump of all your historical data, and then once the connection's in place, we start grading the trades in real time from there.
The API that we use to link up to the Like if, for example, if you're using a MySQL MT4 database, actually performs faster than like any other like visualization thing that's out there right now. So it's within like milliseconds of latency. Like it's fast.
Okay. Thank you, everyone.
Thank you very much.